Happy New Year, everybody. John Griswold here with Griswold Group. I'm excited to fill you in on what's going on in San Diego with the real estate market. I hope everybody had a wonderful holiday. New change for me. I got a big bushy beard, thanks to my wife, Elizabeth, who's been pushing me to grow this out for a little while. So we'll see how long it lasts. But for the time being, the real estate market is primed to have some big shifts coming into the new year. The main reason for that is that interest rates have dropped quite a bit over the last several years, and we're now sitting at an average interest rate at about 6.2%, well below that 6.5 threshold that really helps affordability. So where we're sitting right now, there's a lot more buyers that can qualify to get into a home than when we were seeing average rates closer to 7%. So that should increase demand, which is still at historical low numbers to start the year. Supply is also muted right now. A lot of people take their home on the market, or they pause and delay their plans until the new year. So we're sitting at about 3,700 homes on the market right now. So expect that to rise considerably as we start into the new year. Pre-COVID average was about 5,500 homes is sort of what would be considered healthy. The unhealthy portion of the market has been this very, very muted low demand. And again, very interest rate driven in San Diego. We are very sensitive to interest rates because it's expensive. It's an expensive market. So any deviation up or down in the interest rates is going to have a big impact on supply and demand dynamics. So what could happen over the next several months? I mean, the big thing to watch is we've got a bunch of jobs reports coming out, 2 big ones, or maybe 3 over the next several weeks. If that's sort of within what expectations are, we'll probably see rates stay around where they are. But if we see additional cracks in the economy, cracks in employment, likely the bond market is going to start pricing in lower interest rates, anticipating an additional Fed funds rate cut. So we'll see where that goes. But if that were to be the case, we could see a sort of repricing of rates sort of between 5.75 and 6.25, where right now we're basically between 6 and 6.5. So we'll see. A lot of economists think we're going to stay in the 6 and 6.5 range. So if it were to be downgraded, it would be due to changes in the economy. So hope all of that's helpful, and I'll talk to you on the next one.